Hello and welcome to Anantam IAS. This is the second video in the series of Budget and Economic Survey. If you remember, we are making a series of videos on Budget and Economic Survey. In the last lecture, we have discussed about a theme on state of Indian economy and fiscal developments. In that lecture, we discussed about the state of Indian economy against the backdrop of the global uncertainties and also the fiscal developments that have been taken place in Indian economy in the last financial year. We also discussed about certain taxation reforms that were introduced by the government through the latest budget. And while discussing these topics, we also solved certain MCQs. Right? So just like the last lecture, in this lecture we are going to take up a fresh theme and we are going to discuss about what economic survey has talked about with respect to that theme. And we are also going to solve certain MCQs. My request to the students is to pause the video while solving the MCQs and please note down your answer in the comment section, isn't it? Now let's start with the fresh theme, that is chapter 3, monetary management and financial intermediation. See, in every economy, it is a responsibility of the central bank to take care of the monetary management, right? So as part of the monetary management, the central banks do take certain policy steps to achieve a particular objective. So on the same lines, even Reserve Bank of India with respect to Indian economy had taken certain monetary policy decisions in the last financial year. So to understand what was the context behind this monetary policy, what are these monetary policy steps taken by them, by the Reserve Bank of India, and what kind of impact it had on the Indian economy, you need to understand the broad context. See, the first and foremost objective of Reserve Bank of India is to achieve price stability in the economy. As per the new monetary policy framework, there is a benchmark of inflation levels that was given to it. That means the consumer price index should be around the levels of 4% and it should not go beyond 6% or it should not come below 2%. Right? So price stability, achieving price stability is the foremost objective of the Reserve Bank of India. Once the price stability is achieved, the next objective is to aid the economic growth or enhance the economic growth. Right? So these are the twin objectives. So if you look at the inflation levels in Indian economy in the last financial year, the price levels were pretty much under control. In fact, the measurement of the consumer price index has reached below 2%. That means it has reached around 1.7% towards the end of 2025. By the November and December, India was said to be in a Goldilocks zone, which means the economy was growing at more than 7%, whereas the inflation was hardly 2%. So high economic growth, low price levels, it's a very good scenario, right? So in that context, Reserve Bank of India had taken certain monetary policy decisions. So you must be wondering why the inflation levels come down significantly. There are certain reasons behind it. One such reason was the most important supply side factor, that is good monsoon. Last year in 2025, India had witnessed a very good monsoon because of which the agrarian production was pretty good. And India had also taken one important decision with respect to the taxation, indirect taxes, that is GST slab rationalization. Under this GST slab rationalization, only two rates were retained under the new two rate structure model. There is one merit rate and the other is standard rate. 5% slab and 18% slab. That means all the products which were under 12% slab were brought under 5% slab, and all the products which were under 28% slab were brought under 18%. So this had in fact reduced the prices of the commodities and services. So that is another cost side or supply side impact which has reduced the inflations. So given this context, in this context of low inflation, the RBI had got enough leverage and scope to inject liquidity to enhance the economic growth rate. So that is what RBI had done last year. Okay. So first and foremost, let us discuss each and every decision or each and every policy step taken by the government which are very important for this year prelims. While discussing these policy steps, we are also going to discuss about certain static topics and some current affairs which are very important for this year prelims examination. Okay. The first and foremost policy decision was to reduce the repo rate by around 125 basis points. That means 1.25%. See, if you look at December 2024 to December 2025, in the span of 12 months, there has been a decline of around 125 basis points. 125 basis points, that means 1.25%. It was around 6.5% last year, that means in the month of December 2024, and by December 2025 it reached 5.25%. And in fact, in the latest monetary policy review that was undertaken in the month of February, this month, they retained the same 5.25%. That means they maintained a neutral stance with respect to the monetary policy. They maintained neutral stance. That means they neither increase the repo rate nor decrease the repo rate. From December to April, they have taken accommodative stance. That means the interest rates were reduced to aid the economic growth rate in the backdrop of low inflation. And after that, they maintain neutral stance briefly, and then again repo rates have been reduced. So to understand the impact of this reduction of repo rate significantly in the span of 12 months, you need to briefly understand what is repo rate. And to understand repo rate, you need to briefly understand the liquid adjustment facility. So the reason why we are discussing about liquid adjustment facility is not only understand what was the impact of repo rate, but also there were certain changes that were introduced by Reserve Bank of India last year in 2025 with respect to the LF mechanism, and it is very important. That's why this topic is very important for this year prelims. So what is liquid adjustment facility, LAF? Liquid adjustment facility is a facility extended by the Reserve Bank through which it manages the liquidity situations of the banks. That means banks often face either excess liquidity situation or deficit liquidity situation. In either case, RBI is going to help them to manage these situations. These LF transactions are supposed to be taken through collateral. Let me explain the LF transactions through a very basic example. Let's say when banks are in dire need of short-term liquidity situation, that means when there is a short-term liquidity mismatch, they can take the help of RBI for overnight or for 7 days, 14 days or 28 days. The tenure of the LF transactions ranges from 1 day to 28 days. Right. So let's say banks borrowed cash from RBI for a short term. It needs to keep a certain amount of collateral with it. Generally, the collateral refers to the government securities. The government securities are designated as collateral under LF mechanism, right? So the rate at which banks borrow from RBI for short-term liquidity mismatch, that rate is known as repo rate. That means this transaction is a repo transaction, and the rate at which this transaction is taking place is repo rate. This is a situation where banks are facing liquidity deficit, but there are certain instances where banks do have surplus liquidity. When they have surplus liquidity, they can approach RBI to deposit the surplus liquidity with them. That means they deposited the cash, and RBI is supposed to keep a certain amount of collateral with them. The rate at which the banks are keeping the deposits with RBI is known as reverse repo rate. Reverse repo rate. That means in these two transactions, one thing is common, that is the collateral is supposed to be maintained, and second thing, either there is a liquid deficit situation or liquid surplus situation, the banks are in a position to manage it thanks to the LF mechanism or liquid adjustment facility. That means liquidity situation is being adjusted, right? So generally, repo rate is more than reverse repo rate. Repo rate is more than reverse repo rate. That means the lending rate of the bank is more than the deposits, the rate at which it earns the deposit interest rate under LF mechanism. Okay. Now, in this transaction, whenever we say that banks are supposed to pledge government securities as collateral, we are not saying that banks can use any government security. See, every bank is supposed to maintain certain amount of statutory liquid ratio. Under SLR requirement, banks are supposed to keep a certain portion of their deposits in the form of cash, gold, or government securities, isn't it? But these government securities are not supposed to be used as collateral for undertaking LF transactions or repo transaction. It has to use those government securities which are over and above the SLR requirement. That means those surplus government securities it holds above the SLR requirements. Only these surplus government securities are supposed to be kept as collateral for any repo transaction. But sometimes banks may not have adequate government securities and they're in a dire need of liquidity support from the RBI. For that, for those kind of situations, RBI had given a separate emergency facility known as marginal standing facility. Marginal standing facility is a temporary emergency facility that was made available to the banks, where the banks can actually use the government securities from their SLR requirements. So that is marginal standing facility. It is just like the normal repo transaction, but here the government securities that are being pledged by the bank is taken from the SLR requirement. Since they are not maintaining the SLR requirements because they are using it as collateral under repo transaction, the MSF rate is more than the repo rate. That means it is a penalized rate or it is a penalty rate. So MSF is more than repo rate. Right. Now, what is standing deposit facility? SDF. See, SDF is just like any other reverse repo operation, but the only difference is that the RBI is not required to keep the equivalent amount of the collateral. See, in this situation, RBI is injecting liquid into the banks through repo rate or through repo operation. In this situation, RBI is actually absorbing the liquidity from the banks. For either of these two transactions, collateral is required. But sometimes in extreme situations, when RBI is supposed to absorb lot of liquidity from the banks, it may not have adequate amount of the government securities. It may not have adequate amount of the government securities to keep as a collateral to absorb excess liquidity from the banks. So to avoid such situations, RBI, through the powers given to it under RBI Act 1934, had introduced a new facility known as Standard Deposit Facility. Under Standard Deposit Facility, RBI can attract deposits from the banks without collateral. That means it is just like the normal reverse repo operation but without collateral. Right? So this is about repo rate, marginal standing facility and standard deposit facility. So the gap between marginal standing facility, repo rate and standard deposit facility is constant. That means the gap between marginal standing facility and repo rate is 25 basis points. That means 0.25%. And the gap between repo rate and standing facility is also 25 basis points. That means 0.25%. So the entire LF corridor is with a gap of 50 basis points. For example, let's say RBI changes repo rate. RBI changes repo rate. Right now, the repo rate is, let's say, 5.25%. Right now, the repo rate is 5.25%. So the marginal standing facility rate would be 5.5%, and the standing deposit facility rate would be 5%. So the standing deposit facility rate and MSF rate are going to be increased or reduced depending upon the repo rate, because they have a constant gap between MSF repo rate and SDF rate. So this is known as LAF corridor, and the length of the LAF corridor is 50 basis points, right now, ranging from 5.5 to 5%. Okay. So this is about liquid adjustment facility. You can expect basic questions in the prelims sometimes, but this time there were certain changes that were introduced by the Reserve Bank of India in the LF mechanism. What was the change? See, normally these two transactions, LF transactions, are supposed to be undertaken through collateral. But what are the designated collaterals? The designated collateral till now is only the treasury bills, government securities, and SDL, state development loans. State development loans refers to the government securities of the state governments. Government securities belongs to the state governments, long-term government securities of the state governments. So till now, these three were designated collaterals under liquid adjustment facility. But this time the government introduced municipal bonds into this list. What are these municipal bonds? Municipal bonds are those bonds issued by the urban local bodies. Urban local bodies are supposed to generate revenues from the market, just like how the state governments and central governments are doing it. So whenever their tax resources and their own resources are not sufficient to meet its expenditure, instead of depending upon the state government or central government funds, these rich urban local bodies should be in a position to borrow from their own. So Reserve Bank of India, Finance Commission, and even central government has been encouraging the urban local bodies to start mobilizing the resources through municipal bonds. So designating municipal bond as a security or as a collateral under LF mechanism is going to give a new demand or push for the urban local bodies, right? So this is a new introduction. So there can be a question on this aspect. And the other change that was introduced by or through LF mechanism, liquid adjustment facility, was increasing in the participants. Till now, this LA facility was available only to banks and primary dealers. Banks and primary dealers, scheduled banks and primary dealers, right? As a lender of the last resort, it is the responsibility of the Reserve Bank of India to provide the short-term liquidity facility to all the scheduled banks. Okay. Now, in the year 2025, it had extended to another entity. That entity is this: the unlisted companies holding government securities can also participate. This is very, very, very important. So what are these unlisted companies, and why did the RBI allow these unlisted companies to participate in the LF? See, to understand that, you need to understand the special securities issued by the government. See, from time to time, the government issues certain special securities to certain entities or companies. What are these special securities? See, we all know that government provides subsidy, oil subsidy, fertilizer subsidy, electricity subsidy, or wide range of subsidies. Let's take the example of fertilizer subsidy. See, how is fertilizer subsidy implemented? The government determines the MRP of urea, and all the fertilizer companies are supposed to sell at that particular MRP, irrespective of their manufacturing cost. Let us say I am running a fertilizer company and my company is producing fertilizer or a bag of fertilizer at 1000 rupees, isn't it? But let's say government fixed MRP is 900 rupees. So the difference between the cost of production and also MRP, difference between cost of production and MRP is going to be compensated by the government directly to my account. That means the difference between the manufacturing cost and the government fixed price is going to be compensated by the government directly into the bank account of the manufacturer or the fertilizer company, right? So this is how urea subsidy is delivered, right? Now let's say in a particular financial year the government doesn't have adequate financial resources to pay the subsidy bill to the manufacturing companies or these fertilizer companies. Now what does it do? Sometimes RBI, to avoid such situations, provides some securities or some bonds to these fertilizer companies instead of paying money. These bonds are known as fertilizer bonds. That means government is giving them bonds. Let's say government owes 30,000 crores to the fertilizer companies in the form of fertilizer subsidy, but government doesn't have 30,000 rupees, 30,000 crores of rupees. So instead of providing them the cash, the government issues new fertilizer bonds and hand over to them. These bonds work like just like any other government securities. They have a specific tenure. Let's say the tenure of this fertilizer bond is 10 years. The fertilizer companies can retain these fertilizer bonds for 10 years, and till the 10 years they keep receiving interest rate on this. At the end of the 10th year, at the end of the maturity period, they can redeem them for their subsidy payment. So basically, through issuing these special securities, government is making a deferred payment, isn't it? Government had done this lot of times, like issuing oil bonds, fertilizer bonds, or food bonds, right? Even state governments also often do this, right? Now the question is, what are these companies going to do with these bonds? As I said, they can retain these bonds because they keep receiving interest rate on this, right? Or they can sell it to anybody in the secondary market. Fair enough. If at all they retain their government securities, now with the changing mechanism of the LAF, they can pledge them as securities collateral with the RBI and take short term loans from the RBI, just like how the scheduled banks are taking. That means just like how RBI is providing short term liquidity facilities to scheduled banks and primary dealers, it will also start doing it for those companies to which the government had delivered these government special securities. So these special securities can be used as collateral with RBI, and these companies can take short term loans from the RBI. So the participants under LF facility, the participants under LF mechanism include not only the banks, primary dealers, but also some unlisted companies who possess these special securities issued by the government in lieu of the payment towards them, right? So these are the two important changes that were introduced in the LF mechanism and very important for this year prelims, right? So the first monetary policy step that was taken by RBI is to reduce the repo rate, okay? And the second important step taken by the RBI was to reduce cash reserve ratio. CRR was reduced by 100 basis points. That means 1%. Earlier CRR used to be 4%. Now it reduced to 3% of NDTL. That means out of the total deposits received by a bank, 3% is supposed to be kept with the Reserve Bank in the form of cash. Why a CRR? For which the RBI is not going to pay any interest to the banks. What was the purpose behind CRR? To ensure that the bank doesn't go through any kind of insolvency and to prevent the bank run situation, right? So now it was reduced from 4% to 3%. And other step was to infuse liquidity through open market operations. Infuse liquidity through open market operations. What are open market operations? See, open market operations refers to buying or selling of the government securities from the market by Reserve Bank of India. buying or selling of the government securities. Depending upon the liquidity situation, RBI either purchases or sells the government securities. Since the context was to infuse liquidity in the market in the backdrop of declining inflation, RBI purchased the government securities, thereby providing liquid into the market. Through open market operations, that means by purchasing the government securities in 2025, RBI had injected more than 2 lakh crore in the economy. Around 2.4 lakh crores of rupees rupees were infused by Reserve Bank of India into the economy. And the same thing happened with dollar rupee currency swap. What is dollar rupee currency swap? See, stabilizing the exchange rate of Indian rupee is the responsibility of Reserve Bank of India. To stabilize this exchange rate, RBI from time to time intervenes in the forex market. It does it by selling and purchasing the dollars, right? Through this dollar rupee currency swap agreements. That means today RBI is purchasing dollars at a specified rate and it makes an agreement with the banks saying that it is going to sell it at a particular rate. This dollar rupees currency swap had also infused huge amount of liquid into the market. If you see, just in December, RBI announced that it is going to inject 2.9 lakh crores of rupees through dollar currency swap agreements. Right? That means when RBI purchases the dollars, it ends up infusing liquidity in the market. Right? So these are the 4 important monetary policy developments that have been taken place in Indian economy in the year 2025. Okay. Now let us understand the impact of the result of these monetary policy decisions. Right. The first and foremost impact was increased money multiplication. Increased money multiplication. What is money multiplication and how did it happen? See, look at the money multiplication. The money multiplier increased to 6.2%. It has been increasing since 24. It was around 5.4%. It increased to 6.2% in the span of 1 year. Money multiplier increased. What is money multiplier? Money multiplier equals to money supply by reserve money. Money supply by reserve money. Again, questions have been asked on money multiplication earlier also in the UPSC. So this is very important. To understand how the money multiplication increased given the monetary policy decisions that have been taken by the Reserve Bank of India, I need to briefly demonstrate you the money multiplication process. So what is money multiplication process? Money multiplication process refers to the increasing the money supply as and when the physical currency enters into the banking system. See, the banks do multiply the money or increasing the money supply as part of the regular credit creation. So money multiplication was a byproduct of the credit creation by the banking sector in a fractional reserve banking system. So how does it happen? Let me explain you through an example. Okay. Let us say there is a person A who holds 100 rupees of currency in his pocket. He deposited 100 rupees he deposited that 100 rupees in the banking system. See, what is money here? Money refers to the currency held with the public. Currency held with the public plus deposits made in the bank. This is money. Okay. In this example, there is an individual who possesses 100 rupees note in his pocket and he deposited this 100 rupees in the bank. Okay. Let's take a minuscule example, hypothetical example. Okay. In this case, out of the 100 rupees deposit, the bank has to keep a certain amount to meet its reserve requirements. Let's say the reserve requirement is around 20%. What are these reserve requirements? The CRR, SLR. That means every rupee that is deposited in the bank is not available for the lending or credit creation. A certain point or certain portion is supposed to be kept aside for meeting the reserve requirements like CRR or SLR. Let's say the reserve ratio is 20%. That means out of the 100 rupees deposited, 20 rupees is supposed to be kept aside and 80 rupees is available with the bank for the further lending, right? Let's say 80 rupees is given as loan to another person, Mr. B. Whenever a bank extends loan to a customer, it is generally provided into his bank account. That means it is deposited in the bank account. Now 80 rupees has been credited into the bank account of Mr. B. Here let's take an assumption that Mr. B had not taken a single penny out of his deposit. That means he has not withdrawn any money out of his deposits, right? So Mr. A has 100 rupees in his deposit and Mr. B has 80 rupees in his deposits. In fact, the currency note is only 100 rupees, but it has created a deposit of 180 rupees. That means 100 rupees of currency note has created a money of 180 rupees. So currency is not money. Currency is multiplied into money through regular credit creation process done by the bank in a fractional reserve banking system, right? Now let's look at the cycle. We assume that Mr. B has not withdrawn any single rupee from his deposit account, and out of 80 rupees, the bank has kept aside 20%, that means 16 rupees to meet its reserve requirements, and 64 rupees is available for the further lending or credit creation. This 64 rupees was given as loan to another individual C. Just like how the money is deposited into the bank account of the B, here also 64 rupees is deposited into the bank account of Mr. C, right? So the same 100 rupees note created as money of 180 64, that means 244 rupees of money has been supplied. That means on record, Mr. A has 100 rupees in his deposit account, Mr. B has 80 rupees in his deposit account, and Mr. C has 64 rupees in his deposit account. So the money supply is 244 rupees. The cycle continues further. Let's say C also has not withdrawn any rupee from his deposit account and he retained the entire money that he has received in the form of loan, and out of 64 rupees deposits, 12 rupees is kept aside to meet the reserve requirements, since 20% was the reserve ratio, and the rest 52 rupees is available to another customer, Mr. D, and D was given a loan of 52 rupees which was deposited into his bank account. Now through this cycle, 296 rupees of money has been supplied. So the total money supply is 296, and the reserve money, that means the currency note which entered into the banking system, how much? 100 rupees. 100 rupees of currency note had created 296 rupees of money in this process. So here the money multiplier is 2.9 times. Money was multiplied 2.9 times because money multiplier is money supplied by the reserve money. What is reserve money? If you take this example to the macroeconomic aspect, the reserve money refers to the total stock of currency printed by the reserve bank, right? That is reserve money, and the total money supply. Total money supply by the total reserve money refers to money multiplier. Okay. Now, to understand what factors influence the money multiplication process, I have to demonstrate it through another example. The same example, let's say there is an individual, Mr. A, who possesses 100 rupees of currency note, and that currency note was deposited into his bank account. And out of 100 rupees, let's say now in this example, the reserve ratio is only 10%. Unlike in the previous example where the reserve ratio was 20%, here in this case reserve ratio is only 10%. That means the bank has to keep only 10 rupees aside to meet its reserve requirements, and 90 rupees is available for the loans. unlike in the previous example where only 80 rupees was available. Now 90 rupees available, and this 90 rupees was given to another individual B as loan, and the same process, B was deposited with a 90 rupees in his bank account, and out of 90 rupees 9 rupees is kept aside to meet the reserve requirements, and 81 rupees is available, and that is given as loan to C, and the cycle continues, right? Here, in the same level, at the same level, it created a money supply of 344 rupees, unlike in the previous example where the money supply was only 296 rupees. That means here in this case, money was multiplied by 3.4 times, unlike in the previous example where it was multiplied by 2.9 times. What was the difference here? The difference was the reduced reserve ratio. The reduced reserve ratio. That means money multiplication is inversely proportional to reserve ratio. That means when reserve ratio is reduced, money multiplication increased, because when reserve ratio is reduced, the bank will have more money to provide loans for credit creation. So this is how money is multiplied. As I said, whenever the physical currency enters into the banking system, whenever the currency note printed by the Reserve Bank of India enters into the banking system, the banking system multiplies the money in the process of its regular credit creation in a fractional reserve banking system. What is fractional reserve banking system? Out of all the deposits received by the bank, a certain fraction is kept aside in the form to meet the reserve requirements. So the quantity of the reserve ratio determines how much the money is going to be multiplied, right? Now, to understand the impact of the money multiplication, you need to look at the CRR. The reduction in the CRR, cash reserve ratio, had reduced the reserve requirements, and this had enabled increasing the money multiplication in Indian economy, right? Understood? Now the second impact of these monetary developments was surplus banking liquidity, surplus banking system liquidity. Surplus banking system liquidity. What is banking system liquidity? Simple. Banking system liquidity refers to the readily available cash that is possessed by the banks. Readily available cash that is possessed by the banks to meet certain demands. What kind of demands? See, the demand depositors, when they deposit their money in the bank account, there are no restrictions on their withdrawals. They can withdraw their money whenever they want. So the entire money that is deposited into the bank cannot be made available for the loan creation. The bank at all times has to maintain certain amount of cash, liquid cash with itself to meet its withdrawal demands, and also for any short term business needs or short term operational expenditure. So for withdrawal demands and short term business needs and short term operational expenditure, the bank is supposed to maintain a certain amount of liquidity, the readily available cash with it. Okay. So this banking system liquidity can be either surplus or deficit. That means if the entire all the banks may possess a certain amount of readily available cash to exactly meet their short term liquidity needs, that is a neutral banking system liquidity. That means whatever that is required by the banks, they do possess that extra cash with them. Sometimes they also face banking system liquidity shortage or deficit. That means they may not have readily available cash with them to meet their withdrawal demand and other short-term liquidity needs. Then they take the advantage of liquid adjustment facility and they go to the RBI and take money. Now, thanks to the infusion of liquidity through these four tools, one is reducing the repo rate, reducing the CRR, infusing the liquidity through open market operations, and infusing liquidity in the banking system through dollar rupee currency swap. Banks have surplus banking system liquidity. That means banks have readily available cash more than what is required for them to meet their short-term liquidity needs. Now the question is, what are they going to do with this extra liquidity? Again, they go back to the LF, they take advantage of LF and they use standard deposit facility. That means they keep extra liquidity with RBI for an interest rate, right? For an interest rate. As I said, standard deposit facility doesn't need any collateral from the RBI. It doesn't need any collateral from the RBI. So the demand for SDF increased. The demand for MSF reduced. There will be demand for MSF when there is liquidity deficit. But thanks to the liquidity infusion done by the government, done by the RBI in the last financial year, banks have surplus liquidity and their demand for MSF reduced, but their demand for SDF increased. This banking system liquidity is measured, whether it is surplus or deficit is measured whether the banking sector is a net borrower of the RBI, net borrower from the RBI under LF, or net depositor through LF mechanism with RBI. That means, are they borrowing more or depositing more? Last year, they deposited more than they borrowed. They deposited more than they borrowed. So, RBI is the net borrower, not the banking sector. So, this is another result of these monetary developments, right? And one more important aspect or the result of these monetary developments is efficient monetary policy transmission. Efficient monetary policy transmission. What is monetary policy transmission? The rate change introduced by the Reserve Bank of India should be reflected in the interest rates charged by the banks from the consumer. Sometimes, even when RBI reduces its repo rate, the banks may not pass on the benefits to the end consumer, right? But thanks to these monetary policy developments, banks have enough liquid, so the reduced interest rates have been properly reflected in the banking rate or the lending rate charged by the banks. Okay, so we have seen reduction in the interest rates, banking interest rates in the economy in the last financial year. So these are the three important consequences of these monetary policy developments. So based on this discussion, you can answer any conceptual question that can be asked. Mostly from the monetary policy, the conceptual questions are asked. Okay, let us solve some questions based on the discussion and we'll move to the next discussion, next topic. Look at this question. With reference to liquidity conditions in Indian banking system, consider the following statements. Right. Liquidity conditions in the banking system. That means we are talking about the banking system liquidity. Right. Look at the first statement. If the banking system is a net borrower from the Reserve Bank of India under liquid adjustment facility, it indicates surplus of liquidity in the system. Wrong. See, if banking system is a net borrower, that means they are facing deficit liquidity situation. Only when they have deficit liquidity situation, that means they don't have readily available cash to meet their short-term liquidity requirements. Only then they borrow. So it is a situation of, it is not a surplus liquidity situation, it is in fact a deficit liquidity situation. That is why it is borrowing from the LF. So the first statement is wrong. Now look at the second statement. Banks typically resort to the marginal standing facility during periods of surplus liquidity to park their excess funds. Again, this is wrong. When banks have excess liquidity, they do park with the RBI through which facility? SDF, Standard Deposit Facility, not MSF, not Marginal Standing Facility. Marginal Standing Facility is used by the banks when they face dire situation of deficit liquidity. That means they don't even have adequate government securities to take loan from the government borrow RBI under LF. Then they are going to use their government securities from the SLR requirements. That means the need for the liquidity demand is very high and they don't have the readily available cash with them. So for that reason, this statement 2 is wrong. When there is surplus liquidity, they prefer SDF, not MSF. So both the statements are wrong. So the answer is D, neither one nor two. Okay. Now look at the second question. Which of the following statements correctly describe what the money multiplier measures? What money multiplication or multiplier? It is a measure that shows how changes in the government spending affects a country's economic output. No. It is considered as fiscal multiplier, not money multiplier, the first statement. Second, the amount of money generated by an economy at its maximum output. Wrong. Third statement, the amount of money that a banking system generates with each unit of central bank money. Right. What is central bank money? That means the physical currency that is introduced. That. What is money multiplier? Whenever the physical currency enters into the banking system, how much of money is multiplied? That is money multiplier. So it is an amount of money. It is an amount of money that a banking system generates with each unit of central bank money. That means physical currency. In the previous example, I told you with 100 rupees of physical currency, it created 296 rupees of money. Right. So the answer is C. Now coming to the third question. Which of the following best describes the term monetary policy transmission? Monetary policy transmission. The process by which changes in the central bank's monetary policy decision get transmitted through financial system and affect the real economy. Right. Monetary transmission means the key policy changes, the rate changes introduced by the RBI should be reflected in the lending rates of the banks, and that should ultimately impact the economy. Right. So the first statement, A is the right answer. Okay. Okay. Now that's it with the monetary management. Okay. Every year you this UPSC is going to ask a specific conceptual based question from the monetary management. Okay. So please be careful. Next, financial intermediation or the performance of the banking sector. The next is performance of the banking sector. Okay. Performance of the banking sector, especially the scheduled commercial banks, it is broadly measured by three measurements. One, capital adequacy ratio. Second, NPA ratio. Third, the credit growth. Okay. So performance of the banking sector is measured through capital adequacy ratio, NPA ratio, and credit growth. Okay. So before understanding the trends in the capital adequacy ratio and NPA ratio, let us briefly discuss about what is capital adequacy ratio. See, each and every bank is supposed to maintain a certain amount of the capital. The purpose of the capital is to absorb the losses that may be incurred in the banking operations and protect the depositors' money and run the business of the bank as usual. Right. So every bank has to maintain a certain amount of the capital. But how much of the capital is required? How much of the capital is adequate? That is measured by capital adequacy ratio. To understand capital adequacy ratio, I have to introduce you to this concept of risk weightage. Risk weightage. See, whenever a bank provides loan to any customer, that loan is subjected to wide range of risk, wide varieties of risk. Credit risk, market risk, operational risk. Credit risk refers to that risk where the borrower may return the money or not. The borrower may default on the payment. Market rate refers to the fluctuations in the interest rates. The interest rates may go up or go down, which may impact the profitability of the banking sector. And also operational risk. The banks may face any operational risk like any accidents, frauds, anything. So taking into account of all these risks, at the time of providing loan, at the time of disbursing the loan, each and every loan is attached with a specific weightage. Each and every loan is attached with a specific weightage irrespective of the performance of the loan. Even if the borrower is paying back the interest rate and principal amount EMIs perfectly, but still a certain amount of weightage is given because of the potential risks that are involved with the banking business, right? So depending upon the nature of the loan, a specific weightage is given. See, the examiner is not going to ask you how much of weightage is given to different sectors because it is purely technical. Within each and every sector, depending upon the tenure, depending upon whether it is a secured loan or unsecured loan, a specific weightage is given. So you don't have to get deeper into it. But to make you understand how risk weightage is calculated, I have demonstrated here through a hypothetical example. Okay, let us look at it. The government securities, let's say a bank has invested 2000 crores of rupees in the government securities. 2000 crores of rupees in government securities. Any investment or any loan disbursed by a bank is its asset. Okay, so the asset size is 2000 crore rupees and the risk weightage is 0%. That means the government securities are considered as gilt-edged securities. That means if any bank is investing in the government securities, that investment size is attached with zero risk. So the risk-weighted asset is zero, right? Risk-weighted asset is zero. Now let's say the bank has given 1000 crores of loans to credit card holders. Credit card holders, since it is a collateral free loan, 125% of weightage is given to it. That means 1250 crores is under risk. See, you might be wondering how come the risk weightage is more than the asset value. That means if a bank has given 1000 crores of loan to somebody, why is it attaching 125%? At the most, you may be wondering that at the most the bank may not receive the original 1000 crores. So how come the risk weightage is more than 100%? Here you need to understand that though the bank has given 1000 crores of credit card loans, but the money is raised from the depositors. So it has to pay interest rate to the depositors. So it is not only the loss of 1000 crores of loan that is given to the certain customers, but also the interest rate that has been paid to the depositors. So adding up all these, often the risk weightage can be more than 100%. So out of 1000 crores of loan, 1250 crores is under risk, and let's say 5000 crores of loan is provided to the educational category, and if the risk weightage is 100%, the entire 5000 crore is under risk. And if let's say 7000 crores of loans were provided to the housing category, and if the risk weightage is 75%, out of the total loans only 75% is under risk. That means 5250 crores. So the total asset size is 15,000 crores and the total risk weight asset size is 11,500 crores. So this is how risk weightage is calculated. Risk weight assets are calculated. Based on this risk weight asset calculation, capital is required, capital is decided. The capital adequacy ratio is the capital that is to be maintained should be a share of or a percentage of total risk weight assets. Risk weight assets. As I said, the purpose of the capital is to absorb the losses. So to absorb the losses, how much of capital is required? That is measured through capital adequacy ratio. So this risk weight assets tells you the risk probability. So depending upon the nature of the loans that you are giving, the amount of the capital that is supposed to be kept aside or maintained by the bank. Okay. So as per the Basel 3 norms, it has mandated the capital adequacy ratio should be around 8%. But to be more cautious, RBI had fixed that 9% should be the capital adequacy ratio for Indian banks. So all the scheduled commercial banks are supposed to maintain 9% of capital adequacy ratio. But for public sector banks, it prescribed 12%. For public sector banks, it prescribed 12%. So 9% for normal banks, 12% for public sector banks. Right. Now, look at the capital adequacy ratio. The capital to risk weight asset ratio of all the scheduled commercial banks, if all the scheduled commercial banks reached around 17%. It reached around 17%. That means way above the benchmark fixed by the Reserve Bank of India. The capital adequacy ratio is fixed by the Reserve Bank of India. Depending upon, it is fixed by the Reserve Bank of India. It is 17% right now. It is 17%, way above the 12% fixed by the Reserve Bank of India. That means the banks are in a very good position to maintain the capital. So generally the capital is sourced mostly from the profits or by issuing shares in the market. That means people have confidence in the banking sector. Banks are doing good business. Banks are making good profits, right? And the second measure is NPA ratio. So what is NPA? Non-performing asset. That means any loan that is disbursed by the bank, if it is defaulted for more than 90 days, that loan is considered as non-performing asset. So any loan that is defaulted loan for more than 90 days is considered as a non-performing asset. Okay. However, the definition of non-performing asset is not uniform for all kinds of loans. For agriculture loans, it is the NPA definition is that if it is defaulted for at least defaulted for more than 2 crop seasons, right? It is for more, this is for short term crops, and it is more than one crop season for long term crops. Okay, so this is the definition of non-performing asset. Real. Now the total non-performing asset value is considered as gross NPA. So gross NPA has been declining. The gross NPA ratio has been declining from 11% in 2018 to almost 2.2% in 25. Okay, and net NPA is also being declined. Now you must be wondering, what is the difference between gross NPA and net NPA? The difference between gross NPA and net NPA can be understood by this formula. Net NPA equal to gross NPA minus provisioning amount. Gross NPA minus provisioning amount. What is this provisioning amount? See, as I said, every loan given by the bank should be classified as one among these 4 asset categories as per the asset classification and provisioning norms of the Reserve Bank of India. Every loan that is given by the bank based on its performance should be categorized among any one of these 4 categories. What are these 4 asset categories? The first category is standard asset. That means that loan which is performing perfectly fine. That means the borrower is paying his EMIs perfectly, both the principal amount and the interest amount regularly. For this standard assets, the bank is supposed to maintain 0.25 to 0.4% of provisioning amount. What is provisioning amount? Provisioning amount is a separate amount that is supposed to be kept aside against these assets to prevent any loss in the business. That means this acts as a cushion. This provisioning amount should be sourced from the bank's own profits. That means out of the bank's own profit, a certain amount is supposed to be kept against these assets as a cushion to absorb the losses and to run the business as usual. Right? So depending upon the asset category, a certain amount of provisioning ratio is supposed to be maintained. So for standard asset, the provisioning amount is 0.25 to 0.4%. That means if the loan amount is 100 rupees, 0.25 paisa, 25 paisa or 40 paisa depending upon the type of the loan, it is supposed to maintain separately as provisioning coverage. Provisioning coverage. Substandard asset. What is substandard asset? Asset is that asset whose NPA, it has been NPA up to 1 year. It is NPA up to 1 year. For this substandard asset, the provisioning amount should be from 15 to 25% depending upon the duration of the default. Right? And doubtful asset, that means it has been substandard asset for more than 1 year. That means NPA up to 2 years. For NPA up to 2 years, that means more than 2 years. NPA for more than 2 years. NPA for more than 1 year, but up to 2 years. Loss asset. Loss asset is that asset which the bank had lost any hope of recovery. Loss asset refers to that asset in which the bank had lost any hope of recovery. That is loss asset. For loss assets, 100% of provisioning amount is required. 100%. That means if the asset size is, that means if the loan size is 100 crores, the bank has to keep 100 crores out of its own profit as cushion against this asset. For doubtful assets, it ranges from 25 to 100%. So, if you subtract this provisioning coverage amount from the total NPAs, you get net NPA. Often net NPA refers to the real risk because for the rest of the portion, already provisioning amount is kept aside to reduce the risk. Okay. So net NPA tells you the real risk that is faced by the banking sector with respect to the bad assets. Okay. So this is about gross NPA and net NPA. If you look at the trend that was explained in the economic survey, both the gross NPA and net NPA declined significantly in the last 7 financial years. The gross NPA declined from 11% to 2% and net NPA declined from 6% to almost 0.5%. Very, very good sign. That means the NPS increases the profitability of the banks. Bad loans have been reduced. Okay, why these bad loans have been reduced, we'll discuss in the separate topic in the next slides. So this is the trend of capital adequacy ratio and NPAs of the banking sector as per economic survey. Okay, which shows that banks are working perfectly fine. The performance of the banking sector is very good. Now look at the credit growth. The credit growth also increased, thankfully, with reduced NPS and increased profitability. The credit growth increased by 11%. Credit growth increased by 11%. Okay, it touched almost 200 lakh crores. 200 lakh crores, 195 lakh crores of outstanding credit was disbursed by the scheduled commercial banks in the economy. Okay, so in these three aspects, the banking sector is really working good. Capital adequacy ratio, NPA ratio, and credit growth. Okay. Now, looking at the performance of the regional rural banks. Till now, we were talking about the performance of the scheduled commercial banks. This year, in the economic survey, the performance of the regional rural banks and microfinance institutions were exclusively mentioned by the Reserve Bank, mentioned by the economic survey. So I'm assuming that this may become important for this year prelims. Okay. So to understand the performance of the regional rural banks, performance of the RRBs or regional rural banks, let us briefly discuss the basics of RRBs. What are these regional rural banks? RRBs were introduced or established in 1970s to provide loans to the rural activities. To provide loans to the rural activities. What kind of rural activities? To the small farming activities, traditional handicrafts, artisan industry, and other weaker sections in the rural areas. loans to the farmers, loans to the landless laborers. Generally, these sections do not have adequate collateral, nor do they have good credit history. So, because of these two reasons, they may not get adequate credit from the universal banks. So, that is why a separate set of banks were established by the government. The objective is to provide loans to the rural activities and vulnerable sections in the rural areas. Right. Now, one interesting thing about them is their ownership. The way they are different from the regular scheduled commercial banks is not only with respect to their objective, but also with respect to their ownership pattern. The ownership pattern is something like this: central government, state government, and sponsored bank together own these banks in a specific 50 is to 35, 15 is to 50 is to 15 is to 35. So this is the ownership pattern of all the regional rural banks, RRBs. 50 is to 15 is to 35. That means both the central and state governments together maintain 65% of the share, and any sponsored bank, any other scheduled commercial bank like public sector bank or private sector bank contribute to the rest of the 35%. Okay. So this is the ownership pattern of the regional rural banks. However, this ownership pattern was slightly changed after this RRBs Act was amended in 2015. Thanks to the RRB Act amendment that was made in 2015, the regional rural banks were given scope or chance to diverse their ownership or diversify their shareholding capacity. That means every RRB was allowed to rise ownership or rise investment or share from any other source, provided the combined share of the central government and the state government should not reach or go below 51%. It should not reach below 51%. That means at any cost, regional rural banks are supposed to be public sector banks. At any cost, regional rural banks are supposed to be public sector banks. So even if RRBs were given a chance to diversify their shareholding by raising investment from multiple other stakeholders, it should remain as a public sector bank. So thanks to this amendment, the amendment made in 2015, it could diversify its stake and it improved the capital of regional rural banks. If you see, the capital of regional rural banks increased significantly. It reached 14% over the period, thanks to the amendment made in 2015. Okay. And the second important aspect of regional rural banks is their priority sector lending targets. Unlike other banks, unlike for other scheduled commercial banks, the priority sector lending targets for regional rural banks is 75% of ANBC, aggregated net banking credit. 75%. It is 40% for the rest of the scheduled commercial banks. Right? 75%. And regional rural banks, one unique thing about regional rural banks is that they have certain geographical restrictions with respect to their area of operation. That means RRBs are supposed to be confined to their area of operations of the regional rural banks is supposed to be confined to a certain notified area that is defined by the RBI while giving license to any RRB. That means regional rural banks cannot go beyond a certain notified area. So there are certain geographical restrictions. There are certain geographical restrictions in terms of their area of operations. See, don't go by the name. RRBs can also be operated in the urban areas. Regional rural banks can also be operated in the urban areas, provided the area is within the notified area. That's it. Right. So RRBs are slightly different from the scheduled commercial banks in terms of their ownership, in terms of their PSL targets, and also in terms of their geographical restrictions. This is about RRBs. Now, the government had taken certain steps with respect to improving the situation of regional rural banks. Okay, what was the situation of regional rural banks? There were around 170 RRBs till few years back, and government wanted to consolidate them, that means merge and amalgamate them into just 28 RRBs. In fact, now there are only 28 RRBs under one state, one RRB policy. That means for each and every state, there should be only one regional rural bank. There should be only one regional rural bank. There were around 196 RRBs. They were consolidated, they were merged and amalgamated, and now there are only 28 RRBs. Now, effect of this consolidation drive of government was to enhance the capital base of these RRBs. So, apart from the amendment made in 2015, the other reason for increasing the capital adequacy ratio of these RRBs in terms of it was this one state one RRB policy and the consolidation. That means two or three RRBs were consolidated. It expanded their capital base and it reduces their losses. They could take advantage of the economies of scale now. They could take advantage of the economies of scale and they improve their operational efficiency and it improved their profits as well. It also increased its profits. If you look at the profits, this net profits, it increased from almost 3% to 7%. The profits increased from 3% to 7% thanks to the consolidation drive. So increased operational efficiency, increased advantages of economies of scale, increased capital base, reduced credit exposure. All these things help them in increasing the profits, right? So this is about the regional rural banks, right? Now, the economic survey also specifically exclusively talked about microfinancial institutions. What is microfinance? The loans that are generally given to the weaker sections are low income households and low income individuals. That is microfinance. For meeting the credit requirements of the low income households, a separate license was given to certain NBFCs known as NBFC MFIs or NBFC microfinance institutions. RBI provides loans to certain NBFCs exclusively for providing microfinances. Microfinance means those small ticket loans given to the low income individuals, right? To be designated as NBFC microfinance institution, it has to provide at least 75% of microfinance loans. 75% of microfinance loans. Now, what is a microfinance loan? There is a condition for the microfinance loan. What is a microfinance loan? Microfinance loan is that loan which is collateral free. That means while providing the loan by the financial institution, it should not ask for any security. So first and foremost condition is that it needs to be collateral free and the borrower's annual household income should not be more than 3 lakhs. So borrower's annual income should be less than 3 lakh rupees, which means the definition of the microfinance loan is something to do with the borrower's annual income capacity rather than the size of the loan. Microfinance loan is not defined based on the size of the loan that is given by the bank. It defined by the borrower's income capacity. So microfinance loan is any loan that is given by the financial institution which is collateral free and where the borrower's annual income is less than 3 lakh per year, right? So to be designated as NBFC microfinance institution, that they need to provide 75% of the microfinance loans, right? However, this year the RBI had changed the 75% criteria to 60%. Now it is 60%. That means out of the total loans, only 60% of the loans should be microfinance loans. The minimum requirement is reduced from 75 to 60. Now, what was the context behind this changing in the criteria for NBFC MFIs? The context was weakening financial positions of these microfinance institutions. See, most of the MFIs are under financial stress. After COVID, there has been increasing demand from the low income households from the microfinance, increasing credit demand among these low income households from microfinance institutions. Let me tell you, these NBFC MFIs are non-deposit taking NBFCs. That means they don't take any deposits. That means whatever the loan that is given by these financial institutions are supposed to be completely brought or sourced from their own capital, right? So after pandemic, within the existing capital, there is increased demand from the low income households. So they are not able to meet this 75% criteria, and they're facing financial stress. They're not able to raise more capital. Unlike the RRBs and other scheduled commercial banks, microfinancial institutions are not performing well. So to enable them to revive their financial situation, RBI had temporarily reduced this 75% criteria to only 60% criteria. So this can be very well a question in the prelims. To be designated as NBFC MFI, the institution should provide at least 60% of the microfinance loans, right? Let me remind you one more thing. There are no cap on the interest rate. The interest rate is up to the microfinance institution. However, the EMI or the every month installment should not be more than the 50% of the income of this household, right? And there are no end use restrictions on these loans disbursed by the microfinance institutions. That means the borrower can use it for any purpose. Borrower can use it for any purpose, right? So this is very important for this year prelims. So let us solve some questions based on these two aspects. The first question: which of the following statements is correct about regional rural banks? Which of the following statements are correct about regional rural banks? First statement: they cannot be operated in the urban areas. Wrong. They can be operated in the urban areas provided it is within the notified area. It is within the notified area. B, they are exempted from the priority sector lending norms. Again wrong. For regional rural banks, the priority sector lending targets are 75%. Statement C, they provide credit to the agriculture and other rural activities, right? RRBs predominantly provide loans to the agriculture and other rural activities. Statement D, they are wholly owned by the state governments. Wrong. They are collectively owned by the central government, state government, and sponsored bank in 50:15:35 ratio. Okay, that's it. Now look at the next question on microfinance institutions. Consider the following statements regarding NBFC microfinance institutions. The first statement: they're required to ensure that a minimum of 60% of their total assets are in the form of microfinance loans, right? As per the new category, new definition or new criteria, it is 60%. Second statement: for a loan to be classified as a microfinance loan, the size of the loan must be less than 3 lakh. Wrong. Let me remind you again, the microfinance loan definition has nothing to do with the size of the loan. It is a microfinance loan only if it is given to the borrower whose annual income is less than 3 lakhs, right? So answer is A, one only. So this is about the performance of the banking sector. We have discussed about the monetary management. We have discussed about the performance of the banking sector, performance of the scheduled commercial banks, performance of the RRBs, performance of microfinance institutions. So this is what given in the economic survey. Okay. Next, the performance of insolvency and bankruptcy code. Performance of the insolvency and bankruptcy code. Economic survey specifically talked about IBC mechanism and its performance, and it has been 10 years. IBC code was introduced in 2016 and now we reach 2026. It has been 10 years. So it is worthwhile to discuss its performance and its mechanism, right? So before getting into the performance of the IBC, let me briefly introduce why are we discussing this topic, what is IBC mechanism is all about. See, while banking sector provides loans to the customers, any company or any other business organizations, there are high chances that the business organization or the company may default on its payment. It may get defaulted on its payment. In these situations, the NPS are going to be accumulated with the banking sector. That means the banking sector non-performing asset may be accumulated. This is going to impact the credit creation of the banking sector, and also it may impact the profit of the banking sector, right? To avoid this situation or to address this situation, there was a need for implementing a time-bound insolvency resolution mechanism. A time-bound insolvency resolution mechanism will help the banking sector to recover their dues in a time-bound manner. If it is not going to help, at least it is going to give a certain honorable exit to the sick industries or the sick firms. So the idea of this insolvency bankruptcy code is to either give a chance to revive the business and helps the bank to recover their loans, or send it to the liquidation and provide an honorable exit to the companies. So this entire process should be done in a time bound manner. So that is the major crux of this insolvency and bankruptcy code. So to understand the performance of the insolvency and bankruptcy code, let us briefly understand the mechanism of this IBC. Okay. So first and foremost, IBC application. See, we are talking about the corporate insolvency resolution process under insolvency bankruptcy code. We are not talking about the individual insolvency resolution. We are talking about only the corporate insolvency resolution. Okay. Let's say I am a creditor. That means I own a bank which provided loan to a company and the company had defaulted on it. Okay. Then it can be considered as an insolvent company. What is the difference between insolvency and bankruptcy? Insolvency is a condition or a situation where a company is not meeting its financial liability or obligation. The company is not meeting its financial liabilities or financial obligations. That means it is defaulting on its payment to the loan, to the payment of loan to the bank, or it has defaulted on payment of any operational creditor. That means it has procured the raw materials but it is yet to make the payment, or it has defaulted on paying the salaries to the employees. In any of this case, it can be considered that the bank is in an insolvent position. That means it is not meeting its financial obligations. What is bankruptcy then? Bankruptcy refers to the legal recognition of this insolvency. The legal recognition of this insolvency is known as bankruptcy. So that is the difference between insolvency and bankruptcy. So whenever any company is insolvent, that means it is failing to meet its financial obligation, then the creditor can file an application with NCLT to initiate an insolvency resolution process, provided the minimum amount of default is at least 1 crore. The minimum amount of default should be at least 1 crore. Only then the creditor can file an application for corporate insolvency resolution to the NCLT. Okay. And what kind of creditors? Is it the secured creditor or unsecured creditor? Every creditor. That means anybody who has provided loan to the company, either secured creditor or unsecured creditor, either financial creditor or operational creditor. Financial creditor means they have provided loan to the company. Operational creditor means they have provided certain goods or raw material to the company, but they still yet to receive the payment. They are operational creditors. So any creditor can file initiation or application for the insolvency resolution under IBC mechanism. So both secured and unsecured creditors can file application. Apart from the creditors, even the employees can file a case or file a petition to the NCLT for insolvency resolution of the company, right? Provided their outstanding salaries is more than 1 crore, all the employees can come together and file a common petition with NCLT for resolving the insolvency of the company under IBC mechanism, provided their aggregated default amount is at least 1 crore. And asset reconstruction companies can also file petition under this IBC mechanism, file an application under this IBC mechanism. Why ARCs were given a chance, or why ARCs were allowed to file an application under IBC? See, let's take the case of SBI. SBI has given loan to a power company or any infrastructure company, and that company has become insolvent. Now SBI has sold this loan, this bad loan, to an asset reconstruction company. Now that loan is owned by ARC. So now ARC should be able to file an application in the with the NCLT under IBC for resolution of this resolution of the insolvency of this company. So for that reason, even ARCs are considered as financial creditors, and they are also allowed to file resolution application under IBC. Very, very important. And one more interesting aspect of this IBC is that even the debtor, he himself, can file an application. That means the defaulted company can itself file an application for insolvency resolution. It's not just the creditors, even the defaulted company can do it. So who can file the application? Either the creditor or the ARC or the employees or even the debtor, provided the defaulted amount is minimum 1 crore. Okay. Now, once the application is submitted to the NCLT, National Companies Law Tribunal is the adjudicating authority under this IBC mechanism, which is entrusted with the power to accept or reject this application. But it has to take a decision on it within 14 days. When NCLT takes up this decision within 14 days, if it rejects the application, that the entire process is done and dusted. That means there is nothing to be done beyond it. If it is accepted, then the resolution process is going to be started. So NCLT is going to look at the veracity of the application. That means, as a creditor, if I file resolution application under IBC mechanism against a company, then the NCLT is going to look at whether my claims are right or not. NCLT is going to look into a database in the information utility, and it finds out whether the claims made by me is right or wrong. And it is going to take 14 days of time to cross check and cross verify, and it would take a decision. If it is rejected, fine. If it is accepted, then the insolvency resolution process is going to be kick-started. But before the insolvency resolution process is going to be kick-started, the first and foremost thing that is going to be done by the NCLT is to impose moratorium on the debtor company. Impose moratorium on the debtor company. What is this moratorium? That moratorium is a temporary legal protection given to the company, given to the temporary company, protecting it from being penalized from any other law for sake of recovery of the dues. That means now that the application has been accepted, the company is under the gaze of NCLT. Now none of the debtor or none of the creditor can file any other case and try to recover the assets through any other law. So it is a legal protection given to the company from the application of any other law that may exist. Right? Once the moratorium is imposed on the company, nobody can touch the company's assets. Nobody can touch the company's assets. Right? And the second step after moratorium is to appoint an insolvency professional. Insolvency professional is an individual who has been appointed by the NCLT to oversee the entire resolution process and to help the companies to arrive at a resolution plan. Right? So once the insolvency professional is appointed, this insolvency professional is going to take over the management of the company. Insolvency professional is going to take over the management of the debtor company, and this individual is going to help in drafting an insolvency resolution process or insolvency resolution plan. Now, what is this resolution plan? What is this resolution plan? The resolution plan involves debt restructuring. It involves debt restructuring. What is debt restructuring? All the creditors have given loan to this company and the company has been defaulted. The company has defaulted and they filed an application and the application has been accepted. Now the insolvency professional is going to draft a plan. In that plan, debt restructuring is going to be done. What is debt restructuring? It may involve increasing in the tenure of the loan repayment. If it is a 10-year loan, probably the tenure can be extended to 15 years or 20 years, so that it reduces the present day EMI obligation, right? The present contemporary temporary EMI obligations. So it will give a breathing space to the company, right? Or it may provide a discount on the outstanding principal amount or interest amount. Probably the banks may willing to reduce interest rate, or they are willing to reduce principal amount. Anything, everything comes under debt restructuring. Even conversion of debt to equity. Debt to equity can also be changed. So debt restructuring refers to change in the terms of loan or debt to equity conversion. Debt to equity conversion. That means if the company is not in a position to pay back the loan, it can offer a certain amount of share in the company. It can offer as a compensation, it can offer a certain share in the company so that the bank will get some profits if at all the company is going to be revived. Okay, so the resolution plan involves debt restructuring, number one thing, and it also involves selling of non-core assets. Selling of non-core assets. What are these non-core assets? Non-core assets are those assets held by the company which are not directly relevant for the business. If it is a manufacturing company, probably they have a real estate property which is not relevant to the production capacity, or extra vehicles, extra equipment, extra buildings which are not directly utilized. They can be sold. They can be sold and certain amount of payment can be made to the creditors. So it may also involve selling of the non-core assets, and it may also involve management change. Management change. That means they find out any other investor who is ready to invest in this defaulted company and take over the management and revive the company, right? So all these are part of resolution plan. This insolvency professional is going to draft this resolution plan. However, this resolution plan is accepted, should be accepted, must be accepted by the committee of the creditors. What is the committee of the creditors? It is a joint lending forum. That means all the creditors should come together, form a committee, and they should accept this resolution plan. See, it is impossible to arrive at consensus among the committee of the creditors. So for that reason, IBC has said that the committee of the creditors should accept this plan by two-third voting. Two-third voting. That means 66% of votes are necessary or enough to accept this resolution plan by the committee of the creditors. That means the plan which was drafted by the insolvency professional must be accepted, must be acceptable to the committee of the creditors, right? And this acceptance, the plan should be come into effect within 330 days. The maximum time limit given for this resolution process is only 330 days. So within 330 days, the insolvency resolution plan should be accepted. If it is rejected, if it is accepted, the plan is going to be implemented. If it is rejected, or if it is failed to get it approved by the committee of the creditors within 330 days, in either case, it should go for liquidation. It should go for liquidation. Liquidation is the last resort. If nothing is happening with respect to the resolution process, that means the creditors are not convinced with respect to the resolution plan drafted by the insolvency professional, then it goes for liquidation. It goes for liquidation. That means the entire company and its assets are going to be sold in the market, and the proceeds that may generated from this liquidation process is going to be distributed among all the creditors in a priority basis. That means first security creditors are given the preference, and next unsecured creditors, and next shareholders, next employees. So there is a mechanism, there is a priority to it. That priority mechanism is known as waterfall mechanism, not very important, but liquidation is a last resort. If nothing is going to happen within 330 days, it should be liquidated, and the proceeds are going to be distributed among all the stakeholders. So this is insolvency and bankruptcy code. It provided a time-bound resolution process in case of any insolvency, so that banks are going to recover their dues within time, either through resolution or through liquidation. Understand? Right? So this is IBC mechanism. Now, thanks to this IBC, in the last 10 years, in the last 1 decade, almost more than 3.6 lakh crores of dues have been realized by the banking sector. That means they have filed cases, they have filed petitions and filed applications for resolution with NCLT under IBC. So either through resolution or through liquidation, they have recovered more than 3.6 lakh crores of money in the last 10 years. This is a very, very good sign. That means we have got a very efficient mechanism for recovery of the loans, right? And also, if you look at this, it has changed the credit behavior. It has changed the credit behavior. This is what mentioned by the economic survey specifically. Based on a report on the behavioral impact of the IBC, the trend of transition time of the defaulted accounts have been reduced. That means earlier in 2019, for a defaulted account to be converted into a normal account, it used to take 356 days. For a defaulted account to be converted into a normal account. That means, let's say a company has defaulted on its payment of monthly payments or EMIs to the bank. Okay. Now, to get back to the normal payment, it used to take almost 350 days. That means the banks used to go after these companies to convince them to reduce something, to do something with the terms of the loan, and convince them to pay back their loans on time. It used to take them 350 days. Now it has been reduced to only 28 days due to the fear of IBC. Because they know that these banks have a chance to file an application to the NCLT under IBC mechanism. Once NCLT accepts the application, the company's management is going to be taken under the control of the insolvency professional, and the company, there will be a moratorium that is going to be imposed on the company, right? So they don't want to lose the control of their business. So that is why it has changed the credit behavior. It has had an impact on the behaviors of the companies. So they're immediately, even if they miss out on the payment, it is pretty natural due to the financial risks and due to some market risks. The companies do face certain losses and they may get defaulted. It is pretty natural. But they are not able to sustain these defaults for longer time because of the fear of the IBC, right? So this is specifically mentioned in the economic survey. This was the performance of IBC. It not only helped the banks to realize the recoveries, and also it has changed the credit discipline, and impacted the credit discipline of the companies. And out of the total cases till now, that were referred to the NCLT under IBC, around 57% of them were could be recovered through insolvency resolution plan. That means the business of these companies could be revived, and around 43% of the companies ended up in liquidation. 57% went into resolution plan, 43% went for liquidation. Okay, and this liquidation ratio is going to be reduced further More and more companies are preferring for reviving their business rather than ending up in liquidation. Okay, so this is the performance of IBC mechanism. However, the same economic survey also talked about certain implementation challenges with the IBC. This year, IBC topic is very important both for prelims and mains. You can expect either a prelims question or a mains question or both. Okay. See, notwithstanding all the good things that had happened with respect to the IBC, but there are certain implementation challenges. The biggest implementation challenge with IBC is the delays. As per the economic survey, the insolvency professional, the code mandated to be completed within 330 days, the maximum time limit. However, the actual duration is around 713 days. That means it is taking almost 2 years for these companies, for the creditors to recover their loans under IBC mechanism. See, the larger the delay, the lesser the chances the banks or the creditors are going to recover their loans. Due to the delay, the value of the asset is going to be eroded. Due to the delay, the chance of the company to be revived is going to become very bleak. So that is why IBC had kept a certain benchmark, that kept a certain cap on the time limit, 330 days, not more than that. But however, due to certain issues, the process is going beyond the stipulated 330 days and it is reaching almost 2 years. Why is that? The biggest problem is with respect to the NCLT, the burden on the National Companies Law Tribunal. The burden of the NCLTs, because in India we have very less number of NCLT. We have only 30 NCLT benches. We have only 30 NCLT benches. See, National Company Law Tribunal deals with all kinds of cases related to the Companies Act, not just the IBC cases. It has other cases to deal with, right? So there are no dedicated NCLT benches only to deal with the IBC cases. So obviously there is a burden on the NCLT. Due to the inadequate infrastructure, there is a delay, because NCLT is supposed to take a decision within 14 days whether to accept or reject. Here it is getting delayed. And also, once the resolution plan is drafted and once it is accepted by the committee of the creditors, the resolution plan is supposed to be submitted to the NCLT, and NCLT will take a look at it and gives its approval for its implementation. Sometimes the resolution plan is drafted and it is accepted by the committee of the creditors, but when it is sent to the NCLT for its approval, it takes 6 months, 8 months, because NCLT doesn't have the time to take a decision on this drafting plan, right? So the burden on the NCLT is one of the reasons for the delays in the IBC implementation, delays in the resolution under IBC, right? And the other challenge was inefficiency or inadequacy in information utility companies. What is information utility? Information utility is a repository. Information utility is a repository which maintains data with respect to the defaulted companies. That means all the loans given by the creditors and all the defaulted instances are supposed to be updated in this repository, right? So all the creditors are supposed to update this information voluntarily in this depository, and that depository can be utilized by the NCLT because there is a record of all the transactions. So it becomes easy for the NCLT to take a decision on the application. Now nobody is voluntarily updating their information in this depository. So the depository has become ineffective. There is no cross verifying mechanism in the depository. So the information cannot be cross checked. Whether the information is authentic or not is questionable. So due to the inefficiency of the information utility, it is taking a lot of time for the NCLT to take a decision on the application. Ideally speaking, as per the IBC, NCLT is supposed to take a decision within the 14 days, but it is taking more time because of lack of adequate information, right? And delay in reaching the consensus by the committee of the creditors. This is one of the reasons, right? If the creditors are more, then it becomes much difficult to achieve at the consensus. If not consensus, at least even to achieve two-third voting that is required, even to achieve two-third voting that is required to accept the plan. That is required to accept the plan. Okay. And delays due to the litigation. Delays due to the litigation. What kind of litigations? For example, see, there is a committee of the creditors and insolvency professional had drafted a plan, and the plan is supposed to be accepted by the committee of the creditors. Of course, we cannot expect consensus, so that is why the government, IBC says that 66% of voting is required, not more than that. However, what about the rest of the 33% vote holders? They may not accept it, but still the plan is accepted by the rest of them and the plan is implemented. Now, what is the recourse for them? They file a case in the Supreme Court. So the aggrieved parties always seek justice in the Supreme Court, and the Supreme Court will impose a stay on the insolvency resolution plan. So that leads to delays. Not just the creditors, the minority creditors, but also the debtor company. That means if my company has been defaulted and all the creditors have come to NCLT and filed an application, and they have drafted a resolution plan which is not acceptable to me, then I can file a case with the NCLT showing my objections. See, these are my objections and this resolution plan is not acceptable to me. Fair enough. NCLT is going to look at it. If NCLT says that these objections are not accepted, then I can go to NCLAT, NCLAT. That means there is an appellate tribunal. If I don't get justice there, I can go to Supreme Court as well. So I have various stages where I can stall this resolution plan from being implemented, right? So these are the delays due to litigation, right? And the other challenge is shortage of insolvency professional. In the economic survey, it was clearly mentioned that we don't have adequate resolution professionals or insolvency professionals, right? So that is also one of the reasons for delay. And large haircuts. That means in most of the cases, as a process of debt restructuring, the creditors or the banks are letting go of significant discounts. They are giving significant discounts to recover some dues. If nothing happens, the company is going for liquidation. During the liquidation, the banks do not get any value, because by the time the value of the asset is eroded, and once it is liquidated, the banks are not going to get any value. So they hardly get around 10% or 20%. Sometimes they get only 10% of the total defaulted amount. That means they have gone for 90% of the haircut. So this is also one of the implementation challenges. So economic survey mentioned that these challenges are supposed to be addressed to improve the efficiency of the insolvency bankruptcy code, for a time-bound resolution of the insolvency, and helping the banking sector to recover their dues, to recover their loans and address their NPA problems, right? So this is about IBC mechanism as discussed by economic survey, okay? And in the same banking sector, this is the last topic of banking sector in the economic survey. Pre-packaged insolvency resolution process for MSMEs. See, what is this pre-packaged insolvency resolution plan? This is similar to IBC. See, if you look at the entire IBC mechanism, in the entire IBC mechanism, once the application is accepted by the NCLT, the debtor company has no role in the entire process. See, NCLT is going to impose moratorium, and it is going to appoint an insolvency professional, and that insolvency professional is going to draft a resolution plan in consultation with the committee of the creditors. So it is the insolvency professional and also the committee of the creditors, they are going to decide the future of the company. The debtor company has no role in the entire process except for filing a case with NCLT, NCLAT or Supreme Court if it has any concern. Otherwise, during the process of the resolution, the company has no role. So, this process is generally considered as creditor in control mechanism. That means in the entire process, it is a creditor who is controlling, it is a creditor who is calling the shots, because it is a creditor who is going to accept the application or not reject the application. The debtor has no role in it. See, this is a problematic situation for MSMEs. This is a problematic situation for MSMEs. What happened after COVID? Most of the companies, especially the MSMEs, have been defaulted. They have become insolvent. That means they fail to meet their financial obligations. Some of them fail to meet the employee salary. Some of them have failed to meet their loan dues. Right? So, because of which they were dragged into the IBC mechanism. Once an application has been accepted under IBC, the company is going to lose its control over its business. So MSMEs cannot afford to do this. At least the big companies can afford to do this because they know they can revive their business. But MSMEs are very vulnerable because they run on a very thin capital. They have lot of issues. So to protect the MSMEs, a separate mechanism was introduced as part of IBC by the government. That mechanism is known as pre-packaged insolvency resolution process exclusively for MSMEs. It is only for MSMEs, not for everybody. So if any MSME company has been defaulted, then before the company is dragged into the IBC mechanism, before the company is dragged into the IBC mechanism by the creditors, it has an option. That option starts from here. The debtor company, which is MSME, the debtor company can apply for initiation of this resolution under this pre-packed insolvency resolution process. It is supposed to file an application with NCLT. The NCLT may reject it or accept it. If it accepts, if the NCLT accepts the application of the debtor company, see, unlike in the earlier process, in this process, the debtor company itself initiates for the application. Only debtor company can initiate the application, not the creditors. Creditors cannot initiate application under this process. Now, once the application is accepted, the responsibility on the debtor company to make a resolution plan. The responsibility is lies with the debtor company itself. Unlike in the original CIRP process, where the responsibility of the resolution plan is supposed to be with insolvency professional in consultation with the committee of the creditors. Here it is made completely by the debtor company itself. So a resolution plan is made and it is submitted to the committee of the creditors. If the committee of the creditors accepts it, that means if the plan is acceptable to it, then that plan is going to be implemented. So in this process, nobody is taking over the business of the company. The debtor company is going to run its business, it is going to manage its business. And the plan is submitted to the committee of the creditors and committee of the creditors accepted it and the plan is going to be implemented. That means without disrupting the operations and management of the company, without taking over the management of the company, it is giving a chance to the MSMEs to submit a plan. Fair enough. If at all this plan is not acceptable to the COC, that means the plan is not acceptable to the committee of the creditors, then the committee of the creditors can invite any other alternative plan from any other investor in the market. Who are these investors? There can be any investor or any asset reconstruction company or any other rival company who wants to take over this company by investing in it and taking over the management. They can show their interest, they can send their own resolution plan. So this bidding is done through Swiss challenge method. Swiss challenge method. What is Swiss challenge method? That means the challenge is to beat the any resolution plan submitted by the original debtor company. That means the base resolution plan or the original resolution plan is the benchmark plan, and the committee of the creditors are going to accept invitations or bidding from the other companies and investors who are ready to take investment and who are ready to take invest in this company and take over the company to come up with a better plan than the plan submitted by the debtor company. So it is a challenge to the other investors to beat this plan. If at all they beat this plan, if at all they can come up with a better plan, then committee of the creditors can accept that plan. If nobody can come close to this plan, then committee of the creditors has to accept the original plan, right? That means in the entire process, the debtor is going to have control over it. That means unlike in the earlier corporate insolvency resolution process under IBC, this pre-pack insolvency resolution process is giving more chance to the debtor companies to control the entire process without losing the management control over the business, right? So this is about pre-pack insolvency resolution plan. Let us differentiate these two so that you can understand better. Under corporate insolvency resolution process, that means the previous process, it is either the debtor or the creditor, any one of them can apply for it. But whereas in the pre-pack insolvency resolution process, it is the only debtor, that means only the MSME debtor can initiate it, right? Who is going to get the management control over CRP? It is the insolvency professional who is going to assume the control of the company. But in this case, management of the company continues to be with the debtor, right? And what is the model here? It is a creditor in control model. That means it is a committee of the creditors who are going to take a final call over the resolution. But here it is a hybrid thing, because the plan is made by the debtor and it should be accepted by the creditor. But here in the earlier case, the plan is made by the insolvency professional and it should be accepted by the committee of the creditors. Debtor had no role in it, but here in this case, the debtor has a role in it. So that is why it is a hybrid model, right? So this is the difference between CIRP or corporate insolvency resolution process and PPIRP, that means pre-packaged insolvency resolution process. This is applicable only for the MSMEs, not for the other companies. Okay. Now, with respect to the pre-packaged insolvency resolution process, the economic survey had talked about certain issues. That means despite all these things, despite all these benefits that may given to the MSMEs, this pre-packaged insolvency resolution process could not be so successful till now. Only 14 applications were made under PPRIP till now in the last 4 years. That means it has been 4 years since this new mechanism was introduced for MSMEs. Only 14 applications were introduced, 14 applications were admitted by the NCLT. Now, why? Why this mechanism was not being used by the MSMEs, defaulted MSMEs, is because the MSMEs do not have proper legal or technical awareness to go through this process. Most of the micro, small and medium enterprises do not have the adequate technical and legal expertise to take advantage of this PPRAP. Okay, and apart from this, they also do not have funds to go through this process. They don't have the funds to go through this process. And one more inhibiting factor is the procedural complexity and also the lack of trust over the debtor-led process. No creditor is going to accept the plan made by the debtor company. They have better prospects, better ability to recover the loans through the normal CIRP. So why would they encourage the MSMEs to go for PPIRP? It is creditor in control mechanism, whereas here debtor has a chance, debtor has a role, debtor is also an equal stakeholder. So the creditors do not encourage MSMEs to go through this process. Before the debtors file an application under this process, PPIRP, the creditor would go to the CIRP and file an application to the NCLT under CIRP process. Okay, so these are the reasons why this process could not be successful. So the economic survey asked the government to address these issues and increase the awareness among the MSMEs to take up this process, right? So this is about IBC mechanism as a whole, very important for both prelims and mains this year. Okay, let us solve a question on these two topics. Which of the following statements about corporate insolvency resolution under insolvency and bankruptcy framework in India is correct? We are talking about CIRP, corporate insolvency resolution process. The resolution plan can be accepted by a vote share of 50% of the voting share of the financial creditors. Wrong. It is 66% of the creditors, not 50%. 66%. Okay. The NCLT has the power to accept or reject the corporate insolvency resolution process application. Right? It is the NCLT which is the adjudicating authority for corporate insolvency resolution process under IBC mechanism. So NCLT is supposed to take a decision on the application within 14 days. It can either accept or reject it. Okay. So the answer is B, 2 only. Now, which of the following statements is correct about pre-packaged insolvency resolution process? Pre-packaged insolvency resolution process exclusively meant for MSMEs. Okay. The first statement, only the MSMEs are eligible to apply for the initiation of the PPARP. Right. Only MSMEs, only the debtors are supposed to file the application, and it is applicable only for MSMEs. So first statement is right. The management of the affairs of the debtor company continues to vest with itself till the completion of the resolution. Right. The management of the company is going to be vested with itself till the entire resolution process is completed. Right. So both 1 and 2 are right. So this is about the performance of the banking sector, performance of the IBC mechanism. So that's it with this theme. This is what the chapter 3 of economic survey had talked about. What are the monetary developments, and what are the impacts of these monetary developments, and what was the performance of the banking sector, and what is the status of about IBC, and what challenges are faced by the IBC mechanism, right? So these are the important topics that were mentioned in chapter 3 of economic survey. That's it with the discussion. In the next video we are going to discuss a separate theme, and we are going to solve MCQs on this respective themes. Till then, thank you very much. See you.